got to be a good time, but
Mm,
it just doesn't. It's not on the horizon, we'll say.
okay.
Um, all right. Well, why don't we'll go ahead and get started, so we can kind of maximize our time, and then I'm sure more people will be joining us. So everyone, I'm Jordan Fry, from the Prudent Plastic Surgeon. I'm super excited to have Anthony Morena here with us. He is the principal at Mortar Group, which is a real estate investing group that specializes in, you heard us talking about New York City, specializes in investments in New York City, which I think is really cool because a lot of times we don't hear about that market and almost kind of think of it as a market that doesn't work. And Anthony and his team have made it work really well. And so I've really enjoyed learning about their strategy and what they have done. And so I've invited him here to share a bit about what they do, how they got started, how they make it work, and I'm really excited to hear it and learn more about it. And so, Anthony, I'll let you take it away.
All right, great. Thank you very much. Uh, okay, so I'm going to share my screen. Okay. All right. So yeah, no, thank you. I appreciate it. Again, my name is Anthony Morena from Mortar Group. Um, we'll talk a little bit about Mortar today, kind of what we do, and then kind of how we approach real estate. As you were saying, from a New York perspective, New York market in a bunch of ways has had a bad rap. I think overly more during COVID when that kind of started and everyone kind of flooded south. But I think things have kind of re-regulated themselves a little bit now. Um, but we can get into it. First, just a little bit about us. So we are located in Brooklyn, New York. And our shop is basically a small boutique investment firm. We are investment managers, developers, architects, and construction managers. It's the goal and the precipice for Mortar Group was always to kind of vertically integrate and to combine as many assets of the process together to just make it efficient and streamlined. Um, we focus on New York City primarily. Um, Manhattan, Brooklyn, and Queens have been our specialty, and we're a sub-institutional shop. We target mid-family, multifamily real estate, and it's usually a mix of either ground up development and your more traditional value add or renovation type of work. That tends to fluctuate as market variables change over the years. You kind of shift more towards one or the other depending on where things are. Traditional offerings that we do are the deal size usually 10 to 40 units, that $8 to $40 million, kind of for us, which is a sweet spot. And we stick to New York. Referring back to kind of the idea with COVID and when a lot of shops and investment firms started looking at other cities during the pandemic, I looked at that and I decided to double down on New York. Because the idea is I grew up here, like we were saying earlier, I know this city like the back of my hand. And when I would start to look at other cities and you're starting to kind of dig in and try to learn more about other places, you just don't have that much info and you're dealing with Google Earth and then you're trying to assemble comps and local knowledge and brokers and you don't always get a clear picture. So I try to, in the market that we do, focus on what we know, what my staff knows, what my team knows, and kind of and build off that. So over the years, I started in real estate in 2001. So we're quickly approaching, 25 years in the business. And since then, I've done about 35, approaching 36th offering or investment this year. And we have about 450 investment partners that we work with on these deals as we kind of put them together. A little bit about myself. So, like I was saying, from New York, my background is architecture. I went to school for architecture, became a licensed architect in New York. And right after I graduated, my thesis essentially was how do you take architecture and merge it into development? And how do you blend those two? What happens and how does it all work out? And then I followed architecture school with the real estate program at NYU. And that's kind of where Mortar kind of came from. Our first project was 2001, a ground up construction project. Um, where I thought I knew what I was doing, but I didn't. Took me a long time to do it, but it ended up finishing up well. But it was a great learning process, and from there, it kind of started to grow as far as what we do. It started from like project by project, one at a time. Then we start to grow our investor base, or went from friends and family to 10 people to 20, and kind of this slow evolution over the years to kind of do what we do now. So just to get into kind of the discussion for today a bit, it was just kind of to, I thought it'd be good to kind of hit some points um, about real estate and kind of how we look at it, and different things you can look at in your approach and how you evaluate risk or new offerings, whether it's us or anyone else, and then kind of open up the questions and kind of get everyone's thoughts. I like this quote where it's just kind of real estate's not a get rich concept. It's slow. It's a slow process. Like projects that we do are usually 30 to 60 months. So it's a slow moving ship. So we don't react in a couple of days like the stock market would. Real estate offerings take a few years to kind of find their process and come to completion. So first kind of thought we look at is kind of just in investing in real estate, just take your time, build it out over the long-term horizon, figure out what your goals are, what the objectives are, and put those into place piece by piece and modify as you go. Don't put all your eggs in one basket. Myself and all the other developers and real estate forums out there will all tell you the same thing. Just diversify and kind of spread things out. Real estate is always one of those things where it's a smaller percentage of or allocation of a portfolio in comparison to more traditional stocks or bonds or mutual funds. And then another part is when you're kind of learning about the field and how different sponsors or how deals work, it's understanding investor accreditation, becoming accredited and understanding the process. For most investments like ours, investors are accredited. We go through usually a third party for verification, and that makes us feel a little bit better that we have people that are working with us and understand the risks that are involved, and it also makes investors feel a little bit better, I think, as well. And then finally, real estate's illiquid. If you're investing in a project that takes or a deal that's a 30-month or 36-month deal, it'll be illiquid for probably 2/3 to 3/4 of that time. So it's just something to kind of think about when you go about it. Like I was saying, define the goal. Figure out what your objectives are. Is it a capital appreciation where you're trying to grow savings piece by piece, working towards either retirement or the other hurdles that everyone looks for. In working with a lot of different investors, everyone has a different perspective, a different goal, different tax strategies. So it's always kind of interesting for us, being the smaller type firm that we are. We deal with individuals. We don't deal with institutional capital, pension funds. It's people. That was a conscious decision that I made a long time ago. And I like that perspective of it. So you really get to understand what people are looking for, and how you can create things to generate interest from investors. Some investors prefer passive income or cash flow, that where every quarter they get a check for the life of the offering, which works well. We've done that. Everyone is happy with that. Those are our more traditional kind of value add type deals. The big one that everyone always likes to talk about is the tax benefits and what the strategies are. The more time goes on, you always have new things that pop up in the market that investors are looking to take advantage of. The last 4 or 5 years, was bonus depreciation and accelerated depreciation, which investors got significant write-offs on the beginning of a deal. The new thing that I think has been kind of catching on in the last few years is the self-directed IRAs, where people are using IRA investments to diversify a portion of their portfolios into real estate. And then again, in defining the goal, it's like I was saying, just diversify. And you could also use it as an inflation hedge, which has been something that's been a national issue for the last couple of years, and it continues to be, where you can try to keep up with the market by diversifying your portfolio a bit. Also, on the other side of real estate, it's also important just to know the risks, know what you're getting into. There's different types of risk for each offering, regardless of what kind of investment it is. You have to know your market. Where is it? Or is it national indicators, interest rates, recession fears, concerns, housing demands are things to look at. And then you have the actual individual investment and the asset. What are the risk associated with that particular deal or that particular asset? Um, Construction and painting a room and then trying to flip something are two very different things. So real estate development is, it has some risk with it, so you have to really kind of pick and choose what you do and who you do it with. Financial risk that's associated with projects, which is another hot topic for the last couple of years, is especially with rates. We've had deals that they ended in 2021 where we had construction loans. Construction loans are floating rate debt. Construction loans were at 4%, and the new deals kind of just doubled, tripled, and now all that's starting to come down, which is good, but it can kind of cause havoc on projects. So it's one of those things you really need to keep an eye out. Liquidity risk, as I was saying earlier, in real estate, it's illiquid, so you need to kind of plan accordingly and have proper reserves in place. Make sure a sponsor has reserves in place to deal with things as they arise. When a project starts or an offering starts or an investment starts, everything is always great. But if you've got a 3-year fund, a 5-year fund, or a 3-year deal, there's always going to be some bouncy parts in between, whether people are reading things that are going on in the national market or locally. So it's just always, keeping a handle on what's going on and being able to navigate those risks as you go. And then, one of the big things that we talk to investors about a lot is, who is the sponsor? Who are you working with? What's the sponsor's market presence? For us, like I was saying, we are New York based. I stick to New York. If you give me a neighborhood in New York, I'll know the comps. I'll know probably half the deals that have been done there, or probably more than half the deals that have been done in the last 20 years. That I think that's an important piece. Track record is something that's really important to get an understanding of, for whatever type of deal you're looking at. What's the track record? How long has that person done it, or that team done it? And they should be able to share it with you and talk to you about each deal, the pros and cons, and or the highs and lows of each deal. Skin of the game, is the other one. The sponsor and the investor partner should always be aligned with equity. It's usually a mix of equity, or for us, it's the personal guarantees on senior debt. Personal guarantees from Mortar are basically my personal guarantee. I put up a guarantee that we are going to finish this project, we're going to pay back the bank, and if we don't pay back the bank, Mr. Bank person is coming for my house. So that tends to align everyone together in a rush to finish things well, properly, and profitable. So that's kind of the goal that we try to do. And another one is investor communications. This has become, I think during COVID, we really tried to focus on this and make this better. Just with everyone being out of pocket during 2020 and 21, it was important to kind of really boost communications, setting up an investor portals, quarterly reports, webinars, Zoom calls, that became essential. I think those are really good. Just keeping people in, giving everyone a sense of what's going on is good. Whether there's things that are good or bad, people need to know. Otherwise, it just causes concern for no reason. And another one is understanding tax implications. It's the depreciation, which we touched on a bit earlier, where depending on which investors, an agenda of different investors, what their tax strategies are, these things come into play more than with some others. Some that are looking just for passive income, maybe this is not much of an issue. But we have some investors that are strictly investing for depreciation to offset income or gains from other stuff that they're doing, from a salary that they have, their W-2, they're trying to offset some of that money, that gain, and get some money back. So they invest in real estate. And like I was saying, a self-directed IRA is something that's become really popular. I think we did the first self-directed IRA, it was maybe 2017, 2018, and over the years it's gotten higher and higher, and more investors have been investing that way. And to the point that I'm starting to kind of do it as well. 1031 exchange is another angle, depending on the type of asset, where if an investor is selling an asset and they need to park that money somewhere else to defer their gains, that's an avenue that they could take. And then the bonus depreciation and cost segregation path, which has been slowly tapering off as that went into effect 5 years ago or so, and that's kind of, or maybe longer, and that's kind of coming to an end over the next couple of years. But that's a way to accelerate your tax write-offs during the first years of operation, which again, for someone that's trying to defer income or offset income from a particular year, that's a big thing that comes into play. And then finally, my favorite one is, don't believe everything you hear. Social media is chock full of it. But I think if you really evaluate deals, you evaluate a sponsor, and you get an understanding of your market and what you're trying to do, I think this is a lot easier to navigate. But understand that any sponsor, any firm that says everything is peachy at all the time, it's to be blunt, it's not always like that. If you have a sponsor that's gone through different cycles and has seen every part of the market, you can hear more about the ups and downs. I started in 2021, and September 11th was the first thing to kind of knock me on my rear right out of the gate. We've recovered from that. Our local market saw it kind of drop, came back, and then we went right into a Lehman crash, and we had stuff that went into market right when I think Citibank was $1 a share and they thought Citibank was going bust. It was just that kind of stuff. And you work your way through it, you figure out how to navigate those. And then, with COVID is the same. So just trying to understand, see if a sponsor's gone through that kind of stuff and how they navigate how to deal with it. There's no guarantees in real estate. Real estate is liquid, but it has its ebbs and flows. So you have to just evaluate things carefully. It can go really well at times, but you have to be careful and just make sure you do your due diligence. Like I was saying, not everything will go as planned over the course of a project, but I think communications with everyone, with investors, is good and really kind of helps address that. And then speaking to other investors, keeping in the loop with other people, what other people are doing. I always enjoy the comments and forums and everything else, and really kind of what people are thinking about, what they're concerned about. It's something that I look at, and I think a lot of other investors do, and as they kind of look into new deals. The turtle always wins the race is my favorite saying. So just kind of quick recap, just to kind of give you some case studies about that kind of ties into some of this stuff that we just kind of went over. This is kind of a quick slide of just some of the recent work that we've done. Again, we're New York based. So this is a mix of ground up and your more traditional value add, where a lot of these deals are kind of pulled together in small portfolios and built out over the course of a 36-month investment term with investor groups. A couple quick case studies. This one is in Williamsburg, Brooklyn, 203 Richardson. This was a smaller 3-family building, brick building that we bought, converted it to a 7, basically renovating the interior, adding about 15 feet to the back and adding a floor and a half to the top of it. Overall, ROI was about 158%, and completed valuation went to 6.8%. excuse me, primarily because this is in Williamsburg, Brooklyn, the rental prices are a bit high. We saw a big boost in the area after 22, 23, where, one bedroom apartments are well over 4,000. Don't ask me how or why. It's just that's the market, and that's how everything has been priced in New York. But we timed this one. Well, that's the other. There's no real timing. We had a good plan in place, and we got an extra boost from the market shift and increase in rents. Another one similar, 95 Diamond Street. This one's in Greenpoint, Brooklyn. Similar setup, was a smaller building. And converted to a 7. We depending on what kind of zoning district you're in New York, you're kind of limited a bit. So these tend to be smaller buildings. And like I was saying, we sometimes pull these together into small syndications or fund portfolios of different buildings that will renovate at the same time over a course of a 3-year term. But this one, very similar to Richardson, complete valuation of 7.225, a nice IRR on the investor side of 28.8, and purchase price of 2.1. So it was a nice swing in the positive direction. And then I added this slide because just to give an update of kind of what we're up to. Sometimes you see offerings pop up and people show the deals that they're pitching or they're trying to do, but then they never really give you an update of what's going on. These are a couple that we've done recently. The first one, Urban, is something that we launched in spring of 24. This was a portfolio deal where one of the projects is under construction right now. One of them was already finished. We did a gut rehab of a 6-family. And we closed in April. We listed it for rent in September, and we were just finished leasing it up about a month ago. So it was a really kind of quick hit kind of thing to really kind of make sure we lease, stabilize the building, and then that'll be sold in 2026 as part of the exit. Distributions are on the way, so that one worked out well. We're really happy with the way it came out. MG East River is a deal we're doing now, similar type of thing with two assets under it. One is under construction now. We're just getting the demo phase going, and the other is in design development. Again, Brooklyn, and these are in Williamsburg and Greenpoint. In general, I trend in neighborhoods that are established. For the reason being is that I learned in 2008, with deals that are on outskirts or more gentrifying areas, when the market goes completely belly up, the gentrifying areas are the first to get impacted. So you want some places where it's a little more stable. So we try to work in those kind of neighborhoods. And the final one is 319 Prospect, which we just finished this fall. We started this in fall of 22. Great building in Prospect Heights. It's a landmark neighborhood, low inventory. These units range from about $2 to $3 million each. They're larger, more family oriented apartments. 6 of 8 of them are sold. We just closed on the 6th one 2 days ago. The first investor group has been repaid with their profits sent out yesterday, which is always nice to do. And we expect to be fully done and out of Prospect by the 2nd quarter of the year. And yeah, and that is it. Thank you. Hope that all made sense.
Yeah, thanks, Anthony. That was fantastic. I think like so many of those, the lessons you hit are ones that resonate, or like I'm constantly, trying to remind myself of. My favorite, I think you were saying with your first case study, you were like, well, that timed out nicely. And then you're like, well, there's really no timing. And it kind of, reminded me of, it's sort of like the longer you stay in the game and the more you keep doing things the right way, the luckier you get. And, the more prepared you are, the luckier you get. And you don't rely on those things, but if you position yourself well and like you're doing, keep doing things the right way, it tends to work out more often than it doesn't. And I think that's a great point.
Yeah.
I certainly, everyone, put any questions in the chat box. this is a pretty prime opportunity with one of the more experienced real estate investors that you'll come across in a very, challenging market, and it's obviously been super successful. So whether you're just learning about investing in real estate for yourself and have general questions, whether you're thinking of investing with a sponsor, you have a sponsor here that you can ask, kind of the insider questions to. Um, I just wanted to hit a quick point because you mentioned a few times the self-directed IRA. Can you just briefly go over what are kind of like what that is, how it works, and what are the advantages in terms of real estate?
Sure. Sure. So essentially, you can allocate a portion of your 401k, your Roth, to real estate, or basically not just real estate, any alternative investment. You could put it into crypto, precious metals. There's any alternatives you can shift it into. But the way a self-directed IRA works is that you essentially hire a third-party administrator. Over the years, um, it went from a few operators that are national to there's a bunch more. There's Millennium and Trust. There's a lot of big shops that do it, and they seem to be pretty trustworthy, and people seem to be happy with them. But the way it works is, let's say you want to invest $1,000 of your portfolio in real estate, you would contact the third party. So basically, your money goes to the third party. They help you complete the offering documentation for whatever the investment is, and then the $1,000 goes from the third party to the investment. Then at the end of the investment, let's say you're getting back 1,000 plus $500 profit. That money goes back to the self-directed IRA administrator, and then they put it back into your IRA. So the way the self-directed IRA is, as long as it doesn't go back to you personally, it's still a tax protected investment. So there's a lot of investors that we work with where we'll finish a project with them, we send funds back, it goes back into their IRA. Then we find that if we have another offering, they'll kind of bring it back, and it's just kind of this slow growth. Although diversifying do other things, depending on what markets they like at the time. But that's basically the precipice of it. The general concept of it. Those firms, those third parties, I think they charge a few $100s. I think for the transactions, and there's a few of them, and I don't remember a bunch off the top of my head, but I can always kind of get that if anyone asks or anyone needs. But it's worked out well. We've had a lot of people that have been happy with it.
Yeah, that certainly seems like something that I've noticed and seen getting more and more popular, commonplace as well. So definitely a cool option that is, newer. Um,
Yeah.
what do you say to people or let's say potential investors you talk to who are nervous about investing in New York City, just because of whatever the unique challenges in terms of price, whatever it may be, New York being a very renter-friendly state, which I invest in as well. How do you respond to that?
I think I think every city has its pros and cons. Um, and I think the key is knowing the variables that you're dealing with. So like when I look at a project or, or a development site or a value add asset, I can run through the sequence of what we have to do. What do we have to do to get approvals? What's the consultants we need to call? And you have an idea of how long those things take. New York can get tricky. Um, One, if you don't know how long those processes take or who to contact for those things, you can get
Mhm.
stuck in bureaucracy for a long time. The other part of it is, and for me, it's been a big piece, is we do things that are as of right. The bigger developers that are doing, $1 billion, 1,000 unit high rise in Midtown, a lot of those need special approvals and they have to go through community board approvals.
Mhm.
Though that process takes years. So you have to get different departments to sign off, and each one takes 2 years to sign off. For us, because we're trying to be a little bit more rapid kind of with our ins and outs on each deal, we do everything as of right. So if I find a site, uh, I know what I can build there. I don't have to get any special approvals. I just have to go really through the permitting process.
Mhm.
So that's a big part of it. Um, and then just understanding, the other part is just understanding what the comps are. You know, if land is expensive to buy, but to your point, the rents are also high. So it kind of balances out. You know, if you buy land in Texas, it'll be less expensive, but the rents are also going to be less. So ultimately, the cap rates and everything else and the IRRs all kind of balance out to be the same. It's just the dollar value is higher. Like, and then we do a lot of stuff in Brooklyn, but the minute I cross the river and I go into Manhattan, my same building will be 3 times more expensive. You know, it's just that's just the nature of the beast. But I think if you know how to navigate the markets, it's not as bad. You know, yeah, it's one of the things. Like some people don't like New York, but I've seen people come from outside New York come in and try to do big deals right off the bat, and I've seen it go poorly. But
Hmm.
it's just more because they weren't familiar with how to navigate it. Um, you know, so yeah, I think it's not that bad. I think it's just a matter of knowing what you're getting into and how to work through the system quickly. And that, you know, for me, like my background was architectural, so a lot of developers, when they look at a site or they're going to buy something, they hire an architect, they hire a zoning consultant that has to
Hmm.
do kind of their workup. For us, we do it in house. Like, so if I look at a R10 or R6, I know what I could build there. I could run those numbers in a half hour. And then we've got the construction guys, so we know what it costs. So you can kind of put together all the pieces of the puzzle pretty quickly, and I know what I'm getting into. So usually by time, we'll sign a contract for something, and then by time we close on the acquisition, I pretty much got all my line items set. Like I know what this deal is going to cost. Um, and then it's really up to, executing and then seeing what's on the other side on the general market response when you're done.
Yeah, I think that's as I like, from the outside looking in, I think that's your guys' superpowers. Those two things you mentioned. One, just the intimate knowledge of the city and market, which is reflective of any market, but especially New York is a complex one. And so
Yeah.
you guys having that, and then the vertical integration, especially with your own expertise in architecture. Um, and I encourage again, anyone, please ask your questions. This is like an amazing opportunity. How did you guys navigate or are navigating this kind of higher interest rate environment? We've seen a lot of sponsors that are probably, less experienced get caught up with the adjustable rate mortgages early on, and then all of a sudden rates spiked and going under with deals. How did you guys manage that to still be investing successfully and stuff like that? And what's your kind of outlook going forward?
Sure. No, it's a good question. So, we do two types of deals. We'll do like the value add, traditional value add stuff, and then we'll do construction. Construction is floating rate debt, regardless of when you do it. It's always floating. So you just have to but you build it in interest reserve. So if I'm starting a project today, the lender sets the reserve, and they put that money aside.
Mhm.
They don't leave it to me to figure out how much I think I need, because they want to make sure their money's protected. So they put it in interest reserve and it gets drawn down. On the value add side, I try to fix the debt. So the deals that we did in like 21, 22 was like fixed debt, fixed notes, with the idea that once we stabilize the asset, get everything leased up, it can cruise to a certain extent until the exit.
Mhm.
Now, the problem you run into with any deal, I think, over the last few years is if someone modeled a deal at a certain cap rate or at a certain price to exit, prices have all gone down just because the cost of interest has become so expensive. Now we're kind of on the tail end, hopefully, who knows? We're at the tail end of that where rates are going to start to come down. They're not going to go down to where they were.
Mhm.
I don't think anyone should be modeling that, but they'll come back to a decent point. And then as treasuries start to come down, prices on assets will start to go up a little bit, and you'll kind of catch the exit. So you're riding through the cycle.
Mhm.
Because traditionally with interest rates are usually like a 2-year ride, and then they start to kind of taper down.
Mhm.
Um, so I think we're kind of seeing the beginning of that now. But I think it's just kind of planning and being prepared. And the other part of it is leverage. Um, the deals that blew up fastest are the ones that are highly levered. If you've got 80% leverage on a deal, and then your interest rates go up, you're not going to be able to refinance that just because the cost is too high and the bank underwriter is only going to give you 50% instead of the 80% you already had. Then you've got to do a capital call and you've got to come out of pocket. And if you can't come out of pocket, that's when it goes into foreclosure. And that's when it kind of gets nasty. So it's, for me, it's always trying to protect against the downside. And also, like I was saying, because I put up the personal guarantee, you try to protect against and minimize the downside as best you can. Things are always going to happen. You never know. We had a project that was on a condo deal where we went to market in spring of 22, right before rate hike started, and we had 100 people at the open house. We were great. We were starting to sell units. Everything was moving along, and then the first rate hike happened, and then the second one started, and that interest in sales just disappeared. We sold it, but it took a little bit longer, like that. And so there's some things you can't plan for, but you put in your contingencies, you keep your leverage as low as possible, and you try to protect the capital. As that's ultimately it. If it's not going well, try to find an exit, protect a cap. And during Lehman, we had after our first couple deals, and then we did that. Prices went down. We got out. We finished. We gave investors a return. It was nowhere near what we were originally planning. But at the time, the stock market was down 20%. We came back at like a 12% return. So it was, everyone was happy. But it's, you plan for the worst and you kind of go from there.
Yeah, I think
the
that's
short answer.
Yeah, no, I think that's an awesome answer, and something that, if you're looking for a sponsor, you're looking to invest your money, I think you want to hear an answer like that, and you want to ask questions to elicit an answer, because people who aren't as experienced or are maybe it's always nice to be optimistic, but you have to, like you said, be protecting the downside and always be aware of that and have different plays for different situations. And what you described is exactly how a lot of people got in trouble with investing kind of towards the tail end of those low rates. What was not protecting for downside.
Yeah.
Weston,
Yeah. It's in some deals you
sorry,
could
go
see
ahead.
it, but no, sorry, go ahead.
No, go ahead. Sorry.
No, I was just going to say, sometimes you can foresee it and you can plan ahead. Sometimes you're going to get hit with something in the middle. Like if you have a 3-year deal and year 2 something happens in the market that wasn't planned for at the beginning, you just have to navigate it and you ride it out. But you try to come up with different exit strategies. And for me, it's like you talk to investors like, okay, here we are. These are our options. And this is what I think. We'll get some outside data from consultants. This is what we think we should do, and you get everyone on board, and you follow that path, and you execute. Sometimes if you put your head in the sand and pretend like it's going to go away, that's not going to work. You got to deal with it head on. Sometimes people don't want to do that, but you have to.
Yeah.
It's a risky business. You're shooting for higher returns. And that comes with risk.
Yeah, makes sense. Weston here has a great question. For someone who has yet to but wants to invest in real estate, what do you think is the easiest, or maybe has moderate risk other than a REIT, to get our toes wet before purchasing a first property? Maybe something provides a translational experience prior to purchasing our first investment property. Maybe it doesn't exist, but curious what your thoughts are. If it doesn't exist, maybe discuss how to get into real estate investing, as someone who has little to no knowledge about the space. I'll give my thought first, and then Anthony, I want to hear. I think
Yeah.
a great option for this is kind of investing like passively, like with a sponsor, and you have to choose the right sponsor, and you want someone who's going to educate you along the way, not just someone who says, here, give me your money and I'll send you a check or something like that, but someone who's going to go through the process with you. Because what you're doing is they're buying a property, renovating it or fixing it up if it's a value add, renting it out, etc., and then doing some financing. That's exactly what you'll do with a property of your own, just on a much smaller scale. And you won't necessarily be responsible for it all, but can kind of, ask questions along the way. And certainly a good sponsor will be willing to provide that education. So that's kind of my thought. I don't know, Anthony, what's your take?
Yeah, I think it's similar to that. Like, so for me, when I started, you you tried to study what other people were doing. You know, at the time, it's like, okay, what's this guy up to on this project here? How does he work? You take a look at his plans, you get a sense of what his budget is. You almost try to rebuild it, and then you kind of follow it through and see how it goes. And you're not going to catch all of the nuances, but you start to learn a little bit of the language. From when I started, I graduated architecture school, and then I went to real estate, and they don't teach you how to use an Excel spreadsheet in architecture school. I knew AutoCAD, and I knew how to draft. So you're learning a different language. So for me, it was literally starting from scratch. You don't know the verbiage, the terminology, so you kind of get used to how things work. Um, Sometimes when we have investors that are new, I'll even tell them, don't invest in a deal. Just shadow it for a couple of years or a year. See, ask for the quarterly reports, get a sense of how it's going or what the numbers look like. Or you literally put your toe in the water and you try one out. And you put a small part in, but then you get to see the financials, you get to see the details, and you ask questions of, you know, it really depends on the firm that you work with. Bigger shops, it'll be harder to do that. Um, but yeah, you can kind of learn that way. Like we've had, some people that live in New York, um, that kind of do their own stuff, or they're trying out different things, and they'll come work with us. They'll come see a project. It's like, hey, how'd you do that? Or we'll go see their stuff. So, you're always trying to learn something. You know, you have to constantly be involved. So you're learning from the ground of how to do it from the beginning, but then you're always trying to figure out different ways to do it better. But I think there's a few ways to do it with moderate risk. It's just uh, do your due diligence and observe for a bit, get an understanding of what do these offering presentations or the numbers, what do these numbers mean, where do they derive from. um, when I graduated architecture school, I was like, what the hell is IRR? What's the return on equity? It took me a while to figure out what that was. And then you start to understand it. And it's just, you kind of, once you're a little more familiar with it, then it's a little bit easier to dive in. And then you can kind of work your way in slowly.
Yeah, I think those are all great points, and definitely, at least for myself, before getting in, the most like maybe intimidating thing is working with the numbers, because you might do it and you almost don't trust yourself at first. You go like, okay, am I getting what they're getting? Am I missing some critical step here? So it's just practicing that as much as you can. Um,
Yep.
Weston asks, thank you for the great response. How do you recommend we find a sponsor to get involved? Look at all different places. I mean, talk to Anthony, talk to people, and you gotta really ask them, and the important things like what's your experience, what's your track record, can you give me some examples, what's your investing strategy, can you educate me, walk me through this deal and what the returns are. Like, they should be willing. You're giving someone your hard-earned money to invest. You want to be able to trust them, and they should be willing to give you the time and answers to do that. And I think, like I said, you know, I think, Anthony, the way you go about things is fantastic, and just what someone would be looking for. Um, Frank has a great question too. If someone were to invest with you, can they sell their portion of the deal at some point? What is or are the exit strategies for the investor? So I think that's a great question.
Mhm.
Like, in terms of exit strategies, how does that work? Yeah,
Okay.
I'll let you take it away.
Yeah, no, it's a good question. So if I use a deal or like an offering that we're doing now, it's a 30-month offering, and and we're on the tail end of kind of the raising capital for the deal. And when an investor kind of looks at the offering, decides, okay, I might want to invest it, he signs the docs, you've got about 30 to 45 days. If you change your mind, you're like, hey, you know what? I really don't want to do this. We allow someone to, you just avoid the docs. It's like a return. It's like you can back out if you wanted to. After that, the money gets, the thing with real estate is once the money's invested, the money's spent. Like if before a bank will fund you any money for construction or anything else, you have to use the capital. So that money gets put to work pretty quickly. And then, so what happens is you go through the course of the 30 months and you finish the project, you sell the asset. And then at the end of the 30 months, the asset's sold, then the equity is returned, and then the profits are distributed. So you've got an early window at the beginning of the project, of the process, but then really you have to kind of ride through most of it until the end. That's the tricky part of it. Excuse me.
Yeah, I think that's obviously how you derive the value from it. And you get the cash flow from rents, which is coming in with your checks,
Yep.
however often they're coming in, and then the exit strategy is the big, sale,
Yeah.
especially with these value adds and stuff like this, or some like massive refinancing or something like that.
It depends how long the deal is.
Yes, that's what I was just gonna say.
Yeah.
How do you plan, how long for your exits and things like that?
Yeah. So ours are usually less than 3 years. We used to do longer. But over the years, talking with investors, I got the sense uh, overwhelmingly that people liked shorter deals
Mhm.
where you're going to get a little bit of an offset from your depreciation on your K1. Like everyone gets their K1s annually over the course of the 3 years. You'll get some cash flow. But then the exit is kind of what everyone's looking for. So you do smaller term projects, so they're renovations, they're faster turnaround projects, and then you return capital, and then a lot of things happen with people, just let alone investors, just let alone people in general. One person could be doing one thing one day, and 3 years later they want to do something else. So 3 years I find is a good window where someone can, okay, I invested in it, it worked well. Maybe I'll do it again and try it and take it, or I want to do something else with my money. I want to buy a house, or I had kids, or so it's always kind of balancing it out. So for us, it's 3 years. That's kind of been the sweet spot, the 30 to 36 months. Some funds will go 5 years, 10 years. And those kind of operations really get a chance. They do get the chance to do a refinance at some point between years 5 to 8, if the market's in their favor. But it's a long time to have capital locked up.
I bet. Yeah.
So for us, it's usually a shorter term.
Awesome. Well, we're kind of right at our time, which works out perfectly. But Anthony, I want to thank you a ton. This was an extremely informative and educational session. I mean, I definitely learned a lot, and it's really like refreshing to hear your take on things and with all your experience and kind of hearing not just the positives, but the negatives and how to deal with that. So thank you. Thank you everyone else for your time. And before we sign off, Anthony, if anyone wanted to get in touch with you, what's the best way for them to do that?
You could visit our website, mortargroup.com, mortargroup.com, or you can email me at morena@mortargroup.com. Give us a call. We can set up a Zoom, meet in person. Yeah, reach out, and happy to answer any questions. Even if you're just generally curious about the field in general and how it works, and happy to talk to you. This
Awesome.
was great. Thank you. This is
Yeah.
fantastic.
Yeah, of course. Thank you,
All right.
everyone. Thank you again, Anthony. And
All
I'm sure
right.
we'll
Thank
hear
you,
from you
everyone.
soon.
All right. Take care.
Bye.
Bye.